The financial crisis of 2008, also known as the global financial crisis, was a major economic event that had a significant impact on countries around the world. To understand the crisis, let's imagine a large and interconnected financial system where banks, investment firms, and individuals engage in various financial activities. In the years leading up to 2008, there was a period of economic expansion and easy access to credit. Banks and financial institutions were lending money to individuals and businesses at low interest rates. Many people took advantage of this and borrowed money to buy homes, invest in real estate, and make other purchases. At the same time, financial institutions bundled these loans together and sold them as mortgage-backed securities to investors. One of the primary causes of the 2008 financial crisis was the housing market bubble. Housing prices had been rising rapidly for several years, leading to an increase in demand for homes. As a result, banks and lenders became more lenient in their lending practices, providing loans to borrowers with limited income or poor credit history. This expansion of mortgage lending, combined with the sale of mortgage-backed securities, created a false sense of security in the financial system. However, the bubble eventually burst. Housing prices began to decline, and many borrowers found themselves unable to repay their mortgages. As a result, the value of mortgage-backed securities plummeted, causing substantial losses for financial institutions that held these assets. This led to a crisis of confidence in the financial sector, as banks and investment firms faced the risk of insolvency. The impacts of the financial crisis were far-reaching and affected individuals, businesses, and governments. Let's look at some examples to understand its consequences more deeply. Many homeowners faced foreclosure as they were unable to meet their mortgage payments. Families lost their homes and experienced financial hardship. The collapse of the housing market also resulted in a decline in construction and related industries, leading to job losses and a slowdown in economic activity. The crisis had a ripple effect throughout the financial system. Banks and financial institutions faced severe liquidity problems, meaning they didn't have enough cash to meet their obligations. Some institutions faced bankruptcy or had to be bailed out by governments to prevent a complete collapse of the financial system. Lehman Brothers, a major investment bank, filed for bankruptcy, which sent shockwaves through the global financial markets. The crisis also had a significant impact on the global economy. Stock markets around the world experienced sharp declines, eroding the wealth of investors. Many countries entered into a recession, with a contraction in economic growth and rising unemployment rates. Governments had to implement measures to stimulate their economies and prevent further damage. They injected liquidity into the banking system, provided support to struggling industries, and introduced fiscal stimulus packages to boost spending and investment. Furthermore, the financial crisis exposed flaws and weaknesses in the regulatory framework that governed the financial sector. It became evident that some financial institutions had engaged in risky practices and lacked adequate oversight. As a result, governments and regulatory authorities implemented reforms to strengthen financial regulations, improve transparency, and increase accountability within the industry. The financial crisis of 2008 serves as a reminder of the importance of responsible lending practices, risk management, and effective regulation in the financial sector. It demonstrated how interconnected the global economy is and highlighted the need for international cooperation to address economic challenges. In conclusion, the financial crisis of 2008 was triggered by a housing market bubble and a subsequent collapse in the value of mortgage-backed securities. It had profound effects on individuals, businesses, and governments, leading to foreclosures, job losses, and a global economic downturn. The crisis revealed vulnerabilities in the financial system and prompted regulatory reforms to prevent future crises. Understanding the causes and impacts of the 2008 financial crisis helps us appreciate the importance of prudent financial practices and robust regulatory mechanisms in maintaining a stable and resilient economy. Thank you for watching and subscribe to the channel for more videos. Don't forget to turn on the notification bell.